What if 10 years from now you never had to work for money again? Early retirement isn't about luck or being born rich. It's a system you can start today, even on an average income. So in the next 7 minutes, I'll show you a clear roadmap. How to calculate your freedom number or FI number, what to invest in, how much to save, and how to stay on track through any economy. Grab a notebook. This could be the most profitable quarter hour you spend this year. Have you heard about FIRE acronym? FIRE stands for Financial Independence, Retire Early. It doesn't mean you never work again. It means work is optional because your investments pay your living costs. Hence, you can still create, consult, or build passion projects, but on your terms. Think of FIRE as buying your time back. So, let's dive deep into it with following steps. Step number 1. Define your financial independence or FI number. Start with spending, not salary. So add up 1 year of essential living costs such as housing, food, transport, insurance, and must-haves, then multiply by 25. That's a rough FI or financial independence target based on a 3 to 4% withdrawal guideline. If you spend $40,000 per year, your FI number is about $1 million. If necessary, adjust up for travel for kids or down if you plan part-time income. Step number 2, audit cash flow with needs, wants, and growths. For that, track 30 days of spending. Sort every dollar into needs, wants, and growth or investing plus debt payoff. This simple money map shows where to cut and how to fund your future. Pro tip, automate bill pays to kill late fees. Then automate transfers to savings and investments the day you get paid. Step number 3, crush high-interest debt. Because debts like credit card interests above 18 to 25% can outrun market returns. List debts, then choose a payoff style. For that, use snowball method means smallest balance first, or avalanche method means highest rate first. Negotiate lower rates, roll windfalls into debt, and celebrate each account you close. Momentum is fuel. Step number 4, build an emergency buffer for 3 to 6 months. For that, keep 3 to 6 months of essential expenses in a high-yield savings account. This stops surprise bills from pushing you back into debt and protects your investments during job changes or recessions. Step number 5, raise your savings rate because your savings rate is the engine of early retirement. So increase it from both sides, such as reduce the big 3 costs, like housing, transport, food, and grow income by house refinancing, driving your car longer, meal prep weekly with mastering 10 cheap but healthy meals. Every permanent expense cut is a permanent gain to your FI timeline. Step number 6, automate investing. Set automatic contributions on payday. This is called dollar cost averaging. You'll buy more when prices are low and less when prices are high, but you'll always be moving forward. Hence, automation removes emotion and builds the habit that compounds into freedom. Step 6A, simple diversified portfolio. Keep it boring and broad like this. A low-fee total market stock ETF for growth, a bond ETF for stability, and optionally, an international ETF for global diversification. However, choose an allocation that fits your risk, as an example 80-20 or 70-30, and rebalance once or twice per year. Step number 6B, tax-advantaged first. Use employer matches and tax-advantaged accounts available in your country before taxable accounts. Lower taxes and matched dollars accelerate compounding. When in doubt, ask a local tax pro for rules and thresholds. Step number 7, add flexible income streams. Multiple income streams create resilience and speed up financial freedom. So start with your current skills like consulting, tutoring, freelancing, niche sites, or simple digital products. Aim for one stream that can cover one bill, such as rent, groceries, or utilities. Then scale. Step number 8, minimize fees and protect the plan. Fees are stealth taxes. So, buy low-cost funds. Protect your plan with the right insurance like health, disability, and term life if others rely on you. as well as use strong passwords, two-factor authentications, and consider a credit freeze to avoid identity damage that can cost you years. Step number 9, track what matters by monthly 15-minute review. Each month, track this 3 numbers: savings rate, portfolio balance, and financial independence ratio, with the question of how many months of expenses your investments could cover today. Moreover, set milestones such as 3 months, 6 months, and 12 months of expenses invested. Celebrate progress with low-cost rewards to reinforce the habit. Step number 10, design your freedom life. FIRE isn't the end, it's the start. Decide your post-FI life, such as full stop, semi-retirement, or passion projects. Plan location, healthcare, community, and purpose. Freedom works best when you design it on purpose, not by accident. Finally, here's the recap of your financial independence checklist. Define your FI number, audit cash flow, kill high-interest debt, build an emergency fund, raise savings rate, automate a simple but diversified portfolio, use tax-advantaged accounts, add flexible income, track monthly, and design your finish line. Okay, now you can download the free Financial Freedom Roadmap linked below and subscribe for weekly step-by-step money guides. Share this video with one friend who's ready to retire earlier than they thought possible. Your freedom timeline starts today. Let's build it together.